Welcome to Educational Alpha. Kaya CEO and host Bill Kelly brings you on-the-ground conversations with business leaders, educators, coaches, and industry colleagues from around the globe. In this episode, Bill talks with Mario Therrien, Head of Investment Funds and External Management at CDPQ, a global investment group based in Montreal. The conversation spans from Mario's insight on how working with a pension fund provides him with a deeper sense of the impact of generating alpha. Mario expresses how he strives to leave the industry in a better place than when he started. Listen in.
Welcome to the latest edition of Educational Alpha, where the investor's edge starts with informed consent. I'm your host, Bill Kelly, and today I'm joined by Mario Therrien. Mario, always great to see you.
Great to see you, Bill.
You've become a very good friend over the last couple of years. I don't know if it was Claude Perron or through SBAI, which we're going to come back to in the course of our conversation. But you've been a voracious consumer of some of our product, and we put out this portfolio for the future. And I would say of all the allocators I know around the world, you were the biggest cheerleader before I even really knew you all that well. And I said, wow, this is pretty awesome. So I've gotten to know you quite well since then, Mario, but great to be able to do this segment with you. And while I know you well, the listeners, maybe they don't, and they don't know CDPQ all that well either. So maybe introduce Mario and then a little bit about CDPQ so we have a good backdrop for this conversation.
Well, thank you, Bill. It's great to be with you today. And I sincerely believe that energy brought us together. So we had to collide at some point. And, it's great. It all happened. And I'm grateful for that and the work that we've done and the work that we'll do in the future. We're very aligned on this. I worked for CDPQ now for just a little more than 30 years. So I started 30 years ago in 1992 as a financial analyst at CDPQ. And through the years, I've become, more of the external portfolio manager of CDPQ. From, the get-go, it was more about doing hedge funds, and then it grew to do public markets, long only, and then my sandbox and team grew to occupy what we do today, which is everything that's external managers at CDPQ, from private to public markets and hedge funds. So our team is covering about 15% of CDPQ's assets, which is roughly above $60 billion, across many different GPs around the world. And we cover every external managers in all asset classes where CDPQ is operating. So on this, CDPQ is a pension plan. We're based in Montreal. We have $400 billion in assets, and CDPQ is very much espousing the Canadian model. So it's essentially and mainly an investor that invests directly in markets. We invest across all asset classes, so from public to private. We have a sophisticated team based here in Montreal, but also in various offices around the world. So I mentioned 15% with external funds, but 85% is done directly. So it's all of the main asset classes, from public equity, fixed income, credit, private equity, real estate infrastructure. So we cover the whole gamut of strategies. And my role at CDPQ really is to bring the investment managers and external managers that will complement the people we have at CDPQ, so that we come up with a more optimal portfolio. So why we do external funds? Well, first, it's for the intel in markets, it's for practices. It's to be able to access alphas that we're not necessarily able to do here internally, or it would be too costly to do. It could be co-investments, especially when we are talking about private equity or credit. And these co-investments have become more and more something that we do with our selected partners. And we do external funds to better cover some sectors of the markets, some specific countries. For example, emerging markets, we have a good presence with external funds. Or it could be like very niche type strategies or capital solution, or any strategies that require skill sets that are not necessarily available here in Montreal. So this is what we do. We're the window to the world. We try to bring into CDPQ the best and brightest teams that can have an impact both on the risk and return, but also in making us better investors in general. So I would pause here. That's pretty much who I am and the institution I work for.
And the end investor, and I know you and I have had this conversation many times, and a lot of what I write about, I put hashtag client first. At the very end of this responsibility is many, many people in jobs on the streets of Quebec. So these are pension plans and insurance plans, if I had that right.
That's exactly right, of the province of Quebec. So our clients are all here. So private pension plans and insurance companies, as you rightly said. And so that's, for the whole province. I got to say that it's interesting because with the experience I've been getting over the years, it really takes a different purpose to work for a pension plan as you get older and more experience within an institution like CDPQ. You kind of get a better sense as to what can be your impact in generating value add or alpha. So, we become quite proud of that, and rightly so. We have great clients. We have great governance that's help us really to gives us the degrees of freedom to accomplish what we've been doing over the years. And we've been, as a result of this also, the institution has been able to attract talent and being able to open up offices around the world so that we really have like an international signature today. So CDPQ is an investor, direct investor in most of the marketplaces around the world, and we have direct teams, and we're quite proud of this.
And I knew your tenure extended quite long. I didn't realize it went back to 1992. It's extraordinary. And maybe some of the things you've seen and observed and changes, and maybe if I just think about private equity, I don't know exactly what your role was back in 1992, but I would guess or suggest that CDPQ might have been just allocating directly to the buyout space. But then as you fast forward, I would argue private equity is no longer an asset class. It's a very complex industry. So you've got to think about it. And I think you alluded to this. You think about what sector you want to invest in and what part of the world you want to invest in. And can you do it through secondaries or through co-investments or direct investments? So maybe talk about a little bit of that evolution, because it's, I think the due diligence and the investment process has probably changed quite dramatically.
Quite dramatically. And you're right. If I go back like in the 90s, when I first started at CDPQ, we were the asset allocation was very much Canada centric and it was pretty much like Canadian equities and Canadian bonds and Quebec bonds and hydro bonds. And of course we had real estate, which was probably one of the first alternative asset class within the plan. But then again, we were really focusing in Canada, and, changes in regulation and allowing Canadian investors to invest more internationally brought us to start thinking outside of Canada. And it's this is usually what happens, and this actually happened in Canada, where you have large pools of money investing in a very small market. Canada is far from being the United States, where you find pretty much every asset class. So we needed to find ways to evolve and to diversify the portfolio. And, we had to think about the currency. How do you think about currencies? And it's interesting because when I go back to when I started in the 90s, one of the first things that we were brought to think about was, if we're going to be investing outside of Canada, how do we think about the currency, right? The currency risk. So we hired a few outside advisors and consultants to help us thinking about, how do you modelize this? How do you take decisions around currency or not hedge or not to hedge? And, we were quite focused on public markets, I would say, all the way up to year 2001, 2, 3. And year 2001 through 3, this is where we really started investing in private equity through GPs and funds. And most of the money that we were investing in private equity was through private equity funds. And we also started back then in hedge funds. We started investing in hedge funds in the early 2000s. And of course, you remember the aftermath of the internet bubble. And, we had a few specific idiosyncratic situations here in Canada with Nortel and everything, which kind of brought us to invest more with hedge funds. It's where we built that kind of business. And I would say that the rest of the other alternative asset classes, like real estate was kept on growing and kept on growing internationally. Same thing with private equity, and then we started building sort of the infrastructure craft, and this is where we really invested in bringing the right people along to invest with us, and really the people that were eventually going to do it directly. And when you look at the portfolio today, there has been a big shift from more of a liquid market portfolio to a less liquid markets portfolio. I think also this is a bit of the result of what happened with interest rates over the course of the last 10, 12 years. For example, private debt, private credit is something that we've been very active as an alternative to sovereign debt. Things are changing a bit in the last couple of years, but clearly this has been for us a very interesting asset class where you're able to craft and to have a better handle on the alpha that you can generate through structures and capital solutions. So we've been very active there. And also, I think that the big change also from the 90s to today, again, I mentioned earlier that we were focused on Canada. And, I think that the most recent statistics where I remember 10, 12 years ago, 2/3 of our portfolio was in Canada. And now it's probably 1/3 of the portfolio that's in Canada. So there's been a big shift through outside of Canada. And we've increased our investments with emerging markets as well. We started with China, India, Brazil, Mexico. These were the most favored countries for us. We used external partners, funds. And as you mentioned earlier, I think that through the course of this evolution, what was really, really important is due diligence. So you and I, Bill, can have like a really good idea about going to invest in an alternative strategy. But the disparity between the good and the bad managers in most of the strategies, whether it's private equity, hedge funds, or private credit, can be quite big. Like private equity, for example, has been a good example of that, where you and I may want to invest in buyout, but the first quartile and the third quartile is quite different. So manager selection always has been a key. So we invested quite a bit in the resources, the staff and the process. I think process is very important. Being able to separate talent and chance is something that we've been working quite a bit on over the last 10, 15 years. And this is never an ended story. You always have to improve on the manager selection skill, but also operational due diligence has been for us probably the area on a relative basis where we've invested the most resources, both from a human resources, but also technology, and making sure that we could digitize everything that we do on that space, given that we have so much data from all of these managers. So it's been important. And then it's just to bring the cohesion within a team, working together, building these relationships, nurturing these relationships, making sure you have a good mapping of the world in each of these strategies, making sure that, again, you're always on the lookout on the emerging thematics, emerging situations, emerging, opportunities. So that's been the role of our team, and making sure that we can influence the rest of CDPQ when there's something that's worthwhile, with something that's scalable. And if we don't have the skill here, well, there's some external funds that can help us in that process.
And the market obviously was difficult last year for most allocators. And I think in some of these market cycles, even if you have a return expectation of 7 or 8%, which is where many of the public funds are in the US, you can manufacture that. And sometimes you have to maybe win by not losing as much. And you mentioned hedge funds earlier, Mario, and fairly or unfairly, they've become the punching bag of alternatives for the last decade plus. And I think the unfair side of it is that you've had central banks pumping trillions of dollars of liquidity into the marketplace. The risk on trade was alive and well. There was not a lot of volatility. And I think it's hard for hedge funds to perform. So I think there's maybe a couple of schools of thought. One, I think some of these areas in the hedge fund space did quite well. Global Macro is an example in 2022. But sometimes maybe thinking about hedge funds as a risk mitigating tool as opposed to an absolute return tool. So how do you think about hedge funds from a portfolio construction asset allocation standpoint?
I think that's a very valid point, Bill. And I would say through our history of investing in hedge funds, I would say that the latest iteration, which has been there for now 3-4 years, where we decided to, instead of just running a portfolio of hedge funds of all the strategies and try to achieve like a LIBOR 400 with very low vol, so a portfolio that would contain what I call sort of the strategy that do well on a mean reverting environment, and the strategies that do well when there's dislocation. We actually decided to invest in strategies that would be, would probably have more convexity, would probably do better, well, have a better probability of doing well when we have dispersions in markets, whether it's dispersions within a stock index, or dispersion, what I call macro dispersions between countries, between monetary policies, fiscal policies, where you have more of a reflexive nature. So I think that what we've done over the last 4 or 5 years is to invest and really trying to find the groups that would help us, achieve that objective. Obviously, we've converged towards the strategies that are more macro oriented. So it's more than just investing with a manager that's macro aware. It's a manager that brings a strategy that will do well in the macro environment. The other thing also for us has been systematic trend following. This is a strategy we've always invested in, we've believed in for the last 20 years or so that I've been doing this at CDPQ. And it's a strategy that through time has kind of resisted to sort of the ins and outs. So we've done well there. And the other area where we feel that, it can be interesting, I mean, of course, the quantitative process for us is something that we pay a lot of attention to, whether it's from an equity market neutral point of view or more of a macro point of view. But in equities, we've really focused on equity market neutral, which for us, is something that is probably more optimal. And one detail I forgot to mention is that our allocations in hedge funds is an overlay allocation. So it's not capitalized, it's funded through our credit facility. So, when you use sort of that structure to invest in a hedge fund, which I find is very cash efficient in some ways, you need to make sure that the hedge fund managers that you hire are not too correlated with, the rest of the pension plan, which is mainly like, a lot of equity beta risk. So that's important for us. It served us well so far, and so we're doing it more opportunistically, but a year like 2022 was a good sort of data point for us to show the effectiveness of these 3 strategies.
And maybe just finishing up on, you mentioned fixed income in the private credit space, and that's a market that didn't really exist coming out of the GFC, and now it's well over $1 trillion, and you can get pretty good exposure, high in the capital stack, an adjustable coupon, very good collateral backing it. But as you think about a pension plan, you've got liquidity risks to manage as people are looking for their paycheck as well. I don't know where the risk-free rate is in Canada. I suspect it's probably not too far from the US, higher than it was a year ago, but inflation is high too, so it's hard to keep pace. But how do you manage and invest the liquid portion of the pension plan?
You mentioned the liquid, right? The illiquid?
The liquid portion. So you've got to hold some aside for benefit payments, and is that just in public fixed income, or what kind of return?
Yeah, I think there's a lot of effort that has been done over the years in really thinking about the liquidity that we need given sort of the demography of our clients. I think that's, this is a lot of work, and this is really important work to really understand what should be your liquidity profile. So yeah, we on the liquid side, we still invest in some of these sovereign countries. I would say that the big difference, the big change that we've made over the last 4 or 5 years is perhaps include more of these emerging markets, but specific markets, not all markets. I mean, we have a few fund managers that have more of a broad mandate, external managers in EM, but we've developed an internal team that has the resources, capacity, and expertise to invest. So it's been a bit of a switch from Canadian bonds to some bonds with sort of the most liquid emerging markets out there. Again, it's been a good experience for us, I believe, and there's a lot of understanding about the risks and a lot of work that you do in preparation for that. The last thing you want to be is a tourist in these markets, but I think we've done it in the proper way, in the proper order as well. And we on the risky asset side, well, we still have a large, and it's actually the largest portfolio of CDPQ of public equities. So that public equities portfolio is a global portfolio. It's a portfolio that's both divided by style, so quality, value, growth, Canadian stocks, but also emerging markets. And we're strong believers in one of our investment belief is quality, but we also have a belief in the proper construction of portfolio and sort of the mix between these styles. So it's stylistic approach that brings a portfolio that's probably more all-weather, I would say. Also here from a management point of view, we believe in active management. So most of that portfolio is managed actively here what we have is a blend of internal and external portfolio managers. It's mostly internal, but this is where we see the complementarity between external and internal, where we can kind of slice and dice the needs we have, whether it's like a technology fund or an healthcare fund, or it could be a China local share fund. It could be a small cap global fund. So our team is doing sort of that more surgical work of finding the right alphas and betas that we want to juxtapose on top of that internal portfolio.
So that's all helpful context, Mario. And I mentioned I say client first a lot. And the other tagline, I say it's not easy being an allocator. And I think you've demonstrated that because you're managing around demographics that are changing constantly, investment risk, global macro crises, inflation, recession, interest rate policies, et cetera. So we appreciate all that you do. And that could fill more than 24 hours of the day, but yet you give back a lot to this industry. And I forget if we first met through SBAI or not, but certainly our relationship has been built and cemented around some of the relationships that we enjoy and the cross-pollination of our board of directors and the work we do with Thomas Dionette, and you are now chairing that board. So maybe just as we conclude, talk about maybe the importance of giving back, because I don't know where the hell you get the time, but you do it with a smile on your face, you do it with conviction, and I want to thank you and recognize you for that. But maybe as a public service announcement, we need more like you.
Yeah, well, thanks for these kind words. No, it's there's a lot of work, and clearly, I think that for one thing, I think that we're very fortunate people to be operating in this industry. To me, it's a fascinating industry with all kinds of different people and thematics, and we're at the heart of all of these teams around the world, from politics to more consumer, and it's been quite fascinating for me to have the chance to meet such great groups, people, colleagues, like Kaya, and what you're doing, Bill, is just unbelievable. And as you get older, I find that, and here I'm going to be using the words of one of my mentors, Luke Ellis, that you know very well. Luke always says that you should always try to leave the industry that has given so much to you in a better place than when you started. And I truly believe in that maxim. And it's always about, bringing people around you that will have that mindset. And if we all do this together, I think that the outcome can only be, good. We talked about diversity and inclusion quite a bit, you and me, and over the last few years, this industry has been on the wrong side of the history. So this is an area where we need to really focus and recalibrate things. ESG is something that where both you and I are quite animated. There's a lot of work to do there. There's a lot of work to do there, and we have the means, we have the health, we have the intellectual capital around us to make a change. And this only happens once in your life. So you better take that opportunity and jump on it and just go all out. And there will be a time to sleep, but not now.
All right. Well, I think that's a good place to leave it. Mario, always a pleasure. Thanks for your insights and thank you for your time and certainly for all that you do, because we will be in a better place thanks to you when the day of your retirement comes, hopefully not for many, many years.
Thanks, Bill. It's always a pleasure to be with you.
Pleasure's mine. Please join us on the next segment of Educational Alpha as we look to always put the investor first through transparency, education, and informed consent.